US stocks hit new highs, loving signs that Donald Trump will strike a trade deal with Xi Jinping. And gold slumps below $4,000 an ounce as the shine comes off its safe haven status. That's coming up in our 5 Things in 5 Minutes on Tuesday, October the 28th. And then in our deep dive interview, ANZ's head of G3 Economics, Brian Martin, digs into why 200 basis points of rate cuts by the ECB isn't getting much traction.
Typically, you would expect that as interest rates come down, the marginal propensity to save in the economy would fall, and that would stimulate economic activity. That hasn't been the case, and I think uncertainty has really been at the core of that.
But first, in 5 and 5 with ANZ, US stocks rallied overnight to fresh record highs after comments from US officials and Donald Trump that a trade deal was likely when Trump meets Xi for the first time in 6 years this Thursday on the fringes of the APEC summit in South Korea. Here's ANZ's head of G3 Economics, Brian Martin, on the market reaction to a likely delay in a big tariff hike on imports from China.
Expectations are that we will have the November 10 deadline extended, that there will be agreement on certain aspects that have been thorny, to say the least, over the past year. And markets have taken that in good faith. Mr. Trump said he feels good about talks with China. He hasn't given any specifics, but markets tend to run ahead themselves on an expectation basis. We've seen very strong rallies in Asian equities overnight, and that's spilling through into early trading in New York today.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 1%, the Nasdaq up 1.6%. Japan's Nikkei closed up 2.5% last night. The yield on the US 10-year Treasury rose 1 basis point to 4.001%. West Texas oil futures rose 0.1% to $61.60 US a barrel. Gold fell 3% to $4,014 an ounce as of 4 a.m., having fallen earlier in the night to $3,986 an ounce. The US dollar index was flat, but with all that risk-on sentiment, the Aussie dollar rose 0.6% to 65.55 US cents, and the Kiwi rose 0.3% to 57.65 US cents. Number 2, the Reserve Bank of Australia's Governor, Michelle Bullock, spoke last night at the Australian Business Economists annual dinner. ANZ Head of Australian Economics, Adam Boyton, was there and took away a couple of things. Firstly, she said the RBA is expecting inflation data for the September quarter due tomorrow to show trimmed mean inflation for the quarter of about 0.6%. Now, that's below ANZ's forecast for about 0.9%. Here's Adam.
She then went on to say that if it was to be a 0.3 miss, that would be quite a material miss. So the way I interpret that is that a 0.9 on the trimmed mean CPI is, in the governor's mind, a material miss relative to the Reserve Bank's forecast.
Number 3. Adam says his second takeaway was the governor saying the labour market in Australia was still a little tight.
She went on to add that when they look at forward indicators of the labour market or their liaison program, they're not actually expecting or seeing any evidence of a significant deterioration. So you bring those two things together, what it suggests to me is that if we're right on that printing at a 0.9 for the September quarter, it's unlikely the Reserve Bank Board will ease in November.
Number 4. Thailand yesterday reported much stronger than expected export growth of 19% in September from a year ago, despite all of these tariffs. But that doesn't tell the whole picture, says ANZ economist Crystal Tan, because electronics and gold exports made up around 15 percentage points of that 19 points of growth, with exemptions on tariffs playing a role there.
Exports are a key component of GDP, but it is the contribution from net exports that matters. So, for example, despite the surge in electronic exports, Thailand's net electronics trade deficit has in fact widened. So this suggests that a significant portion of the export boom is actually linked to high import content. So that limits the domestic value added and therefore mutes the positive impact on real GDP.
Number 5. We get South Korean GDP data later today, and Crystal is expecting a 0.9% rebound in the quarter for annual growth of 1.4%. She says, though, that construction investment remains sluggish, and she expects an easing of growth in the current fourth quarter.
That's mainly because the positive impact of recent supplementary budgets will start to diminish, while the drag from higher US tariffs, which came into effect in August, will become more pronounced. The Bank of Korea is really in a bit of a tug of war. On one side, softer growth and contained inflation argue in favor of monetary easing. But on the other hand, continued volatility in the housing market and foreign exchange pressures are making the central bank more cautious. So Bank of Korea held rates steady in October, and while we still believe there's room for another 25 basis point cut, the focus right now is on ensuring stability.
Crystal tan there. Now, in our deep dive interview, ANZ's head of G3 Economics, Brian Martin, looks ahead to this Friday's rates decision by the European Central Bank, expected to be a hold, and digs into why 200 basis points of rate cuts by the ECB haven't gotten much traction.
The evidence we've had from consumer activity really since the Liberation Day tariff announcement by Mr. Trump in the US, which resulted in a 15% tariff on euro exports to the United States, has been one of, I think, heightened anxiety. Consumer confidence remains low. The level of real retail sales volumes in the economy has flatlined. Real private consumption growth is not showing signs of picking up despite the rate cuts. And interestingly, the European savings rate has continued to rise. It's now at 15.4% for the second quarter of this year, which is the latest data we have. And typically you would expect that as interest rates come down, the marginal propensity to save in the economy would fall, and that would stimulate economic activity. That hasn't been the case, and I think uncertainty has really been at the core of that.
And what about business credit? Because you'd think as well that businesses would go out there and invest and hire when interest rates were lower, but maybe not so much.
Absolutely. I mean, what we are seeing is hiring in the euro area is slow down. In the second quarter of this year, it was running really at half the pace that it ran during 2024. And I think businesses have just slowed down a little bit. Europe is a very open economy. Its export sector is very exposed to higher US tariffs, as we know, but it's also exposed to the fact that there's surpluses in manufacturing production globally, particularly in China. And I think businesses are a bit concerned about an inflow of goods over and above the norm, that could depress their pricing power, etc. So they've gone slow on the investment side of things. They've gone slow on the hiring side of things. The PMI data and the IFO data we've had out for October for Germany in particular being a bit perkier. But, one swallow doesn't make a summer. And when we look at the underlying credit conditions in the economy, they remain quite soft. We had the September M3 data out this morning, and that actually showed that lending to the non-financial sector fell back from 3% year on year to 2.9% year on year. So businesses are cautious. Yes, rates have come down. Yes, that's good news, but it's not, let's rub our hands together and gleefully go out and borrow a load of money because business conditions are looking really bright out there. They're not. And we still have the geopolitical uncertainty of the Ukraine, etc. So there's a lot of things complicating the transmission of money from rate cuts to the real economy.
So how should the European Central Bank view this then? Because, they've been on hold for a bit.
They have been on hold for a bit, and I think they're quite happy with the view that they've cut rates. They've certainly got them down to much closer to what their estimates of neutrality are. The ECB's view of the neutral real interest rate, for what that's worth, is about 0%. So with inflation slightly above 2%, with the key benchmark rate at 2%, rates are slightly negative at the moment. But that creates a problem for the ECB. What do they do going forward? Hiring has slowed, consumer demand remains slow, the savings rate remains high, as we've mentioned. And therefore, looking at the ECB's forecasts, they are actually projecting a decline in inflation in 2026. So if they want to keep monetary policy in a good place, if they don't cut interest rates again, based on their forecasts, it looks as if the real policy rate is going to rise. And is that something you want to be doing when you're trying to get the economy going? So I think the ECB are going to tread carefully. I think they will maintain an easing bias, but so that markets don't run away with themselves, I think they'll say it's data dependent. But I don't think they can signal that they're at the end of this easing cycle yet.
And do you think they might need to, at the end of the year, cut rates?
I do. We've got one more 25 basis point rate cut penciled in, and December potentially could produce that, which is why we've got it in there. And the reason for that is in December we will get the updated macroeconomic forecasts. We will get the first look at what the ECB is thinking about the inflation dynamics and the economy for 2028. And if the inflation forecasts, either headline or core, suggest that inflation is going to be sub 2%, well then you are having a persistent undershoot in inflation. And given the ECB's mandate, which is solely focused on inflation, I think it would be incumbent on them to cut interest rates again.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, October the 28th. Catch you tomorrow with the results from South Korea's GDP. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.